Hello, hello. You may already own Disney. Either you, your parents, your pension fund, or any other funds that you may own, like an ETF or a mutual fund. So, why am I being a little bit bearish here? Isn't this a super strong moat company? Won't they be growing through the years tremendously? Well, yeah, but there are some problems here, and I'm going to explain in detail. But first things first, let's examine the earnings here, see what is going on with the company. You'll see what they did here. They performed in the fiscal first quarter here. They did more than the street expected, the 1.63 versus 1.57, with a revenue of 25.98 versus 25.74 that was expected. So, why are they down? It looks like their numbers are pretty solid here, right? Let's keep reading. Now, the in the outlook, this is the guidance, what's going to be happening for the next quarter. The company said that they are going to repurchase 7 billion in stock and they do expect double-digit growth in earnings per share. Now, for the fiscal second quarter, they project that the streaming unit, which consists of Disney Plus and Hulu, is about to do 500 million in operating income, which is an increase of about 200 million compared to last year. And this is kind of key here because with Disney, the biggest mode, the largest mode for Disney is basically the parks that they have. Parks is the money maker, and streaming is the sort of like the this wife that is actually spending the money of the husband, pretty much. So think about it this way. Let's say that this company is actually making 100,000 or let's say $1 million in profit from a restaurant, and then they decided to make a food truck somewhere around San Francisco, which is not the best area for a food truck. And so they are spending a ton of money. So they are spending, let's say, 90% of what they make on streaming. So they spend 900,000. This is kind of the situation right now with Netflix, spending a ton of money in content amortized through the years and making just a little bit out of it. And so they are subsidizing the growth of streaming through the really solid earnings that they make from parks and other revenues of that sort. So this is the story, and this is why people are becoming a little bit careful about potentially adding Disney to their portfolio, even though it's obviously a super strong company in terms of moat, right? Now, the interesting thing, and this is also sort of like a red flag here for me and probably other investors too, the fact that they see modest growth in operating income due to international visitation headwinds at domestic parks, and as well as pre-launch costs is interesting because this is guidance. This is what's going to happen, and this could be one of the core reasons why the stock price is actually down right now, about 6%, as they are looking to replace Bob Iger as well. Is another thing, the CEO of the company. And yeah, generally speaking, this is what you are seeing streaming strength, sort of, because they're trying to make it look strong, but the reality is that they're spending a ton of money to subsidize it. And obviously, sports pressure not doing really well here in terms of sports. Now, the box office is kind of up and down, like you can have some good movies, some bad movies. For the most part, previous years haven't been great for Disney, but this is not the kind of business that we want to rely on for sure. Now, Disney said revenue in its streaming business was up 11%, but again, you have to account for all the money that they spend on it, which is a ton of money. And also, revenue for the sports segment is not great, since operating income decreased 23% to almost 200 million here. Very interesting. Now, we will examine the tool here and see the finer details about the company. Now, you will notice that it's been down, generally speaking, quite a lot. Like in the last, or I should say, not down, basically sideways. It has been having its cycles, but for the most part, it hasn't grown, is the thing. So right now, it's sitting at about 106 as it's down right now pre-market, or yeah, it's actually pre-market. No, the market is open. Sorry, my bad. When I'm recording this video, and PE ratio is sitting at 15, going down. Now, this is obviously a good thing. It points to a cheap company, and you may be thinking, okay, this could be value here, and it could be. But again, I'm going to explain. I already kind of did why I think that some parts of the company are not really great, frankly, right now, and I'd like to see where they head with this. I consider streaming basically and the sports and other segments, but basically streaming because this is the big one that's actually spending a ton of money. I consider it sort of like the metaverse of Disney. But the problem is that the metaverse you could ditch easily, and this is what they did in Meta. This one is more ingrained to the business, and it's going to be tough to take the loss and move on. Frankly, I think Disney should be a company that is creating content and just licenses it to platforms like Netflix, and also do what they do best, which is their parks. This is, I think, should be the model for Disney, and this is where they would strive. And if they ever did that, I would be buying instantly, frankly, for me. Now, revenue and net income and all that is still up, but again, you have to place the asterisk of the tons of depreciation, cutting down not on their profit, they are still making profit, cutting down on the potential is the thing. They could be making way more, is what I'm saying here. So it's like a cost of, an opportunity cost with Disney. You could still buy it and probably do well through the years, but you could see some years with sort of like rigid and steady non-growth, sort of like linear or maybe staying at the same spot is what is going on with the company pretty much. This is what we're seeing. With the margins basically doing well, very well actually. They are kind of rebounding, but again they have this thing hanging over their heads, the fact that they spend a ton of money, and you can see it in the cash flow statement. In the cash flow statement, you will see a ton of content getting amortized. You will see it in the depreciation, amortization, billions of dollars getting amortized here, and these are expenses. These are actual expenses amortized through the years. So we're talking about like 25 billion in a 5-year period here of amortized content. Basically, content written down because it depreciates is what this is. And the free cash flow still they are doing well. They had some hiccups here, but they're back to significant growth here in terms of that. So don't get me wrong. I'm not saying that the company is actually going to bankrupt or anything. Not even close. They could still do well, and buying it through the years likely will, make you some money. But what I'm saying is that I see an opportunity risk here, buying a company that could be stale for a while. So this is why I wouldn't be myself. It's not like my top choice for sure, not even close actually. So yeah, this is what we're seeing from the company as they are trying to cut down a little bit on their liabilities here, which is nice to see. But the thing that I mentioned earlier, and I want to stress, is again, it's not that they're not making money. Top and bottom lines look good, and you will see that they keep expanding. So no problems there, and the net income also keeps increasing and very nicely also in the last year. But again, it's just this problem with spending money down the drain, pretty much. And again, if this was a situation like the metaverse, I could dig it, but this is a little bit different. It's gonna take a lot to actually stop working on it altogether. I don't think it's gonna happen, and I'm a little bit unclear on how they would be making money out of streaming in these days. I find it very tough. Now, yeah, the amortization is what I mentioned here. About it talks about the operating income, but massive non-cash amortization charges. And take a look at this: 24 billion content spent for 2026. So real cash returns are still a long way off. Subsidizing growth, pretty much, is what they're doing here. So yeah, you can understand that this is the huge problem here with the company. That it's gonna be tough to tackle is the problem. So yeah, this is what we're seeing with Disney. But do tell me what you think. I'd love to hear your opinion. And of course, you can examine all the finer details in stockainsights.com. See all the details about the company that you may be interested in. Also, the stock alerts is one that we could examine in detail. But for this video, I'm just going to also take a look at the discounted cash flow model because our opinion could actually steer if we have a super cheap company. We could be accepting some of the stale potential risks in terms of growth. And if I run it here with a required return of 13%, which is my typical, this is auto-completed pretty much, you will see that the company is still overvalued because of the cash flows it produces don't really reach the price of the stock right now. Now, the required return is steep, what I ask for. You could go for something like 9%, which is probably closer to the WACC of the company. But 13% frankly makes more sense for investors. Then you're much, much closer to the reality of the company right now. This would be how much the company would worth in terms of its capital, sort of like if we are doing an acquisition. But if we're investors here, we mostly care about getting some sort of return. So 13% makes more sense for our case. Now, so yeah, this is where I have some concerns about the company. Again, don't get me wrong. It's still obviously a super known company, great company, making money. It's just that I find that capital could potentially, my capital at least, could potentially be spent in better opportunities. And I could see this one sort of being sort of like stagnant for a while just because of these issues. Again, it's not the profitability, it's the fact that they are burning a ton of cash in segments that just don't work really well. So yeah, that's what I wanted to say. Give me your opinion about Disney. Are you actually bullish on it? I'd love to hear it. Leave a comment below. I'm basically reading all of these and I will be replying to your comments. Thanks for watching. Bye bye.